Hello everybody and welcome to Sunbird webinar about 7 golden rules for the novice trader. Um, my name is Bastian Ruben and yes, it is record. My name is Bastian Ruben and I'm Sunbird FX Chief Analyst and I'm your host tonight. Those of you who are not familiar with me, this is my 6th or 7th webinar with Forex Pros. And as I said, I'm Sunbird FX Chief Analyst. Those of you who are unfamiliar with Sunbird, the company was established in late 2005 and serviced the institutional market. Among our clients today are hedge funds, white labels, brokers, dealers, and so on. In 2010, the company Sunbird made a strategic move and decided to approach the retail market, but with the offering that will suit institutional. All right. So as you can probably hear, English is not my mother tongue, so let me apologize in advance if I have slipped here and there. All right. So this webinar theme is mainly for beginners, but experienced traders would find it relevant as well, since realizing the basic rules of trading can turn an experienced trader, an experienced but unsuccessful trader, to a winner. Now, let's start from the end. Anybody who trades forex, stocks or commodities or any kind of instrument that exists does it for one reason only: hoping for maximum profits within a minimum time. And the way to this utopia can be frustrating and difficult, but profitable and exciting at the same time. Now, if you know how to control your mind, remaining calm and relaxed, you will increase incredibly your odds for success. I believe that trading is all about mentality. You might have the best trading technique ever prevented, but if you don't know how to control it and manage your money appropriately, you will end up losing. So I will demonstrate the importance of the mentality with my own story. I have finished the trading school 7 years ago and started trading with a small amount of money, something about 5,000 euros. For some of you it's small, for some of you it's not, but for me at the time I already realized that 5,000 euros was not a lot of money. Things went up and down alternately, but I felt that something was missing. I decided to quit my job and give up a great salary so I can be minded just to trading. That sounds like a good idea, like a good decision, you know. The idea was that I would concentrate only in trading, but eventually I found out that this was one of my fatal mistakes. Every trade that I did, I felt like my rent is dependent on it, and it made me stress. And being stressed while trading causes wrong decision making and obviously increases your losses. Over the years, I found the position that allowed me to combine between my work and trading, and the improvement appeared immediately. So my advice to you, and this is probably the answer for one of the questions that deals many traders, at least the one on the beginning of the way, that don't rely just on the income from trading as your only income. All right, you should aim to this status, though it will cause nothing but losses in the beginning of the way. So remember, the money will come if you stay calm. All right, don't jump to quit your jobs or quit any other incomes that you have. Try to find a way, again, on your beginning of the way in the trading world, trying to find a way to combine between your everything that you do for a living and trading. Right? You might reduce the hours that you work or anything else, but if you cut your main income, you won't be able to trade calmly, and then you will probably lose your money. All right? So the first rule that I want to talk about, is the controversial leverage. Now, let me start with saying that no matter what is the maximum leverage that your broker allows you, a trader that uses leverage of 1 to 100 is a gambler. Obviously, there is not a perfect answer for a question, what is the suitable leverage? Since obviously it varies from each trader. However, you should determine what is the maximum loss that you can take per trade and match the size of that trade with the maximum potential loss of this trade. So the result will be the size you should use. For example, let's say that you want to you find a potential trade idea in any pair, and you're saying to yourself that you're willing to take no more than $100 loss per trade. Now, you're analyzing the trade and you find out that the potential loss or the stop loss order should be put something like, let's say, 100 pips under your entry level. In this case, you should not use more than 1,000. All right, you divide the potential loss and the maximum loss that you're willing to take. So the appropriate leverage, from my point of view, is somewhere between 1 to 5 and 1 to 30, and 1 to 30 is pretty huge, actually. But sometimes you can use it. All right. A question. All right. How much is the total capital for 100 pips? Again, the question is how much you are willing to lose. If you're willing to lose, let's say, $100 for one trade, and you know that the potential loss is 100 pips, then you shouldn't use more than 10Ks. All right, it's pretty simple. All right, great. So after realizing this rule, you know, because sometimes trader doesn't know how to determine or how to set the size that they use. So this is a simple way, actually, to work with permanent sizes, and you know, over time each trader will have its own point of view on the market, and the trade ideas will be probably the same, meaning that it's not that you're going to trade one trade on the, let's say, on the 5-minute chart and one trade on the weekly chart. During time, you will adjust your own technique and your own perspective on the market, and the sizes and the stop loss and even the profits that you gain will be probably similar from each trade. So that's why it's much easier to work with permanent sizes. All right, let's move on. So this is the first rule. It's very important. Don't use high leverage, and always figure out how much you can lose from a trade, and obviously how much you can earn from a trade, but we're going to discuss it within a few minutes. All right, so in addition to the leverage, as I said, you got to understand how to to calculate the potential loss. Now, setting the trade's targets before you enter the market makes it much easier to manage the trade from the moment the position is opened. Now, the reason for that is, once again, mentality. If I try to set a stop loss order while I'm in the trade and the trade is losing, I probably set it as far as I can in order to give it as much air. And by doing that, I'm not following technical analysis basics, and my losses are wider than they could be. Therefore, you should not let the human nature to affect your management, and you can do it by setting automatic stop loss orders before you enter the market. All right? It's very important to understand that before you open a position, you gotta understand what is the trade targets. And the trade targets are not only the take profit levels, but also the stop loss levels. And by saying automatic orders, I'm not talking about robots or programming. All I'm talking about is stop loss orders, future orders. Okay, and this is actually an automatic order. Stop loss order is actually an automatic order, but I'm not talking about any kind of robots. All right, so same for setting the stop loss orders. You should also know what is the potential of the trade. All right, so take profits targets should be set ahead as well. There are several systems for taking profits. For example, dividing the size of the trade for different targets. This is how I work usually. I never, for example, let's say I open a position of one standard lot. I never close the whole position on the first target. I usually divide it for partial profits, halves or quarters. It depends on the trade. I talk about it on my other webinar about money management, which you can find on our website. But the point is that you gotta have the targets for profits. All right, targets for profits and targets for losses. So now that this is what I talked about is very easy to talk about, but the hardest question is, how do I implement it? How do I set the potential losses or the potential profits? Now, in order to do that, we have to understand the basics of the technical analysis. And we need to understand what is resistance and what is support. And this is the answer for setting any kind of target when you analyze the chart. All right. So I see there is a question. Am a broker, but not a good broker. All right, it's not a question. So in order to spot the potential trades and setting their targets, we have to understand why resistance and supports occur where they do. Both of these phenomena are made by the two players of the market, obviously buyers and sellers. All right, so as you can see, there are three causes for this phenomenon. We'll talk about resistance and the causes for the support. So when a currency is blocked by a strong resistance, it means that many sellers showed up at the resistance level and did not let it break through. Now, the more the resistance touches many candlesticks, the more we say it is a strong resistance, and it would be harder for the currency to break it through. However, if a breakup of a strong resistance occurs eventually, the possibility for a successful breakup is higher. Alright, so let's take a quick overview on the three causes. So let's take a look at point number 1 on the left side. Now, here, many buyers bought the currency. This example is the euro against the Swiss. Those who bought or entered the market in the long position around this level suffered from hard declines to point number 2. Now, what do you think? Do you think that they realized their position? Did they sell it? The answer is that they probably didn't do it. Now, most of the traders that holding a very losing position, and in this case it's like 10% or even 15%, usually wait until the position gets back to the break-even point. And this is actually the cause number 1, the disappointed buyers. When the price goes back to the break-even point, they close their position. Hold on. So when the disappointed buyers are closing their position, they're actually selling it and they are resisting the price. This is cause number 1. Cause number 2, there are the lucky buyers or the professional ones that take profits. Meaning that, let's take a look at point number 2. It's the bottom of the bearish session, and many buyers went in the market in this point or somewhere along the uptrend, and they see cause number 1. They see the disappointed buyers, and they know that there is going to be a resistance here. So what do? They also sell their position. All right, they're realizing their profits. So they're also resisting the price on point number 2. Point number 3 are actually the sellers. They are looking back at point number 1 and point number 2, and they know that there are good chances that the strong resistance is going to be around the level, and they decide to open a short positions. Short position is actually selling the currency. Selling the currency is resisting the price. So we have 3 causes: the disappointed buyers, the professional or the lucky ones, and the sellers. Now, this is very important to understand how the resistance and the support, which we're going to talk about in a few minutes, happens. Because when you understand that, eventually when you will analyze your charts, you will be able to look at a chart and say where most of the buyers and the sellers are going to be. And it will be much easier for you to understand the potential of a trade, whether it's going to be a profitable trade or losing trade, right? So this is the resistance phenomenon, and the support is actually the opposite. We're going to talk about it really quickly. On point number 1, if we add on the resistance phenomenon, we add the disappointed buyers. Now we have the disappointed sellers. They sell the currency around point number 1, and when it rose, obviously they did not close their position, the losing position, and waited until the pair gets back to the break-even point. So when it does, they cover the position. Covering a short position meaning that they buy it. Buying it means support. Cause number two for the support phenomenon is again the professional or the lucky sellers that had a hunch to get in the market, and they sell somewhere around points number two, and they know that there are going to be some sellers that will have to close their position around the support level. So they close it as well. They realize their money, their profits. And again, covering a short position is actually buying it. Buying it means supporting the price. And point number three are the buyers that, again, taking advantage of the short positions covering that were made by sellers number one and number two. Any question about that? It's really important for you to understand how the resistance and support work. This is the key for many of your trade ideas that you will ever think about. If there are any questions? Of course, everything I say in this webinar or any kind of my webinar is regardless to the time frame you're looking at. It can be whether it's a 5-minute chart, daily chart, 1-hour chart, or weekly chart. It's the same analysis, same technical analysis for all of the time frames. The only thing that changes is the intensity of the trade, the speed of the trades, and so on. But the analysis is the same. A great question: how can I avoid false break? Well, I talk about it in my other webinars, but the thing is that I never open position on extreme points. I work with a reversal technique, but I'm not going to talk about it right now. The proper time frame, again, it's the same for 5 minutes or weekly or daily. But again, in this point, I always show the daily charts because I believe beginners, and not only beginners, should trade mainly the daily chart. But yeah, the strongest supports and resistance are obviously on the daily chart, the long time frames. All right. All right. Let's move on. So, is it true that results of the news has big influence in breaking support resistance? Well, I don't think that the creation of support or resistance has something to do with any kind of news, but sometimes, yeah, important news or events can cause breakouts or breakdowns. Yeah. All right, so we're moving forward to rule number 4, which is limit the number of trades per day. I've met many traders that had the ability to make money in the markets, but yet their cash balance was negative. One of the reasons for that is over trading. A trader that makes 15 trades a day and opens 5 positions at the same time will probably end up in the red zone. Alright? Now, it is almost impossible for your eyes to track more than 2-3 positions at the same time. And by the way, 2 to 3 positions is a lot. I don't think that you should open any trader should open a position until the previous one is closed, or at least it's secured. All right. I always try to open a new position only when the previous one is closed or secured by stop loss orders. You know, because when I do it, when I know that the other trade is secured, I'm not thinking about it, and I'm completely minded to the new position, and I don't let anything else to interfere with the money management and everything else that I need to do in order to make this trade a winner. Now, another element that causes overtrading is reversing from short position to long position and vice versa. It's a common mistake that beginners do, which obviously causes for nothing but painful loss. And if a trade doesn't work, just leave it. Don't reverse the position, direction whatsoever. You will lose your money for sure, and your losses will be doubled. Alright? So overtrading can erase your account actually. And the reason is when you do many trades, even if each trade has only small losses, you know, it's one loss and another loss, another loss, and eventually it's one big loss. Another thing is obviously the spreads or the commission that you pay for your broker. The more you do more trades, the more you pay. So this is something that you have to keep in your mind. All right, you're asking about the support, the resistance. Oh, I'm not saying that we're selling or buying in any point. It's not. I'm not suggesting any kind of technique yet. It's just for you to understand how the resistance or why the resistance actually occurs or happens. Same for the support. So we're not buying in point number 2 or point number 3. As I said, in point number 3 in the resistance, there are some sellers, but I don't like to do it because it's not a real technique, just gambling. All right, so let's continue. Now, one of the most important thing is, you know, many of you, or I don't know many, but some of you did a theoretical trading course, whether it was just general technical analysis school or forex trading course. The problem with all these schools is they don't provide the most important thing, which is the practice. Now, there are many robots, many signal providers on the web which you can find. Be aware of that. My best suggestion for you on your beginning of the way and until you will find your place in the forex market is, first of all, don't try to develop a new kind of strategy, right? Just be sure that probably anything that you can come up with, someone have already tried it, and so don't waste your time on it. The best thing you can do is to stick with professional trader or traders and learn from their experience. Find someone or a group or whatever that works for you, maybe a forex forum with great traders that can actually give you the practice element that you need so much on your beginning of the way in the forex market. You can find basic trading strategies on the learning zone at sunbirdfx.com. We have the education center. You can find it there. I can show it to you. I'll show it to you later. Also, you can subscribe to our newsletters, in which I send every morning to our customers my daily analysis. And my educational daily analysis, as it sounds, it's not about saying buy the euro or sell the Swiss. It's educating. And I always teach about my techniques and how I see the market. So this is one option for you, how to stick with successful trader and to learn from its actions. Now, it can be me, it can be anything else that works for you, but you gotta understand that developing a new kind of strategy will be probably a waste of time. All right? So, for example, and this is linked to the question that someone just asked, how to avoid false break. And as I said, I usually don't look for extreme points. I use the reversal techniques. So for example, as you can see here, it's a trade idea that I sent to our clients a few months ago, and the idea was, as you can see here, the entry level was around here, and the target level, the target for profit was actually the support. So my motto is try to find the wise spots, and try to get in there and get out where everybody thinks that it's good to get in. All right? I mean, most of you probably think that you need to open a short position right below the supporting area. But no, I say that this should be the exit point. It's hard to understand how to open a position here where I did, but it's something that will come in time, and if you learn the reversal technique, you will be able to do it as well. My stop loss level was above here, this short tail that you see of the green doji candlestick. This was my stop loss level. All right. So the total profit of this trade was, as you can see here, 330 pips. But this was not my best trade of 2011. 2011, I sent our customers a trade idea on the US dollar against the Canadian dollar, which gained, I think, 700 pips. It was my best trade for 2011. Now, sometimes, obviously, we have unsuccessful trades, but the secret is to, I mean, you can never know whether a trade is going to be a success or a failure. So the secret is that your losses would be as small as possible and your profits will be higher as possible. So in this case, again, I suffered from a false break, as you can see here. All right, false break, and that was the entry point around 0.98. Stop loss, as you can see here, was under this support, and false break, it fell down to the stop loss level. I closed the position and I moved on. But the total loss here, as you can see, was just 75. So if this week I made just two trades, one of them 330 pips, profits, and the other one is 75 pips minus, the outcome is that I gained total something like 250 pips, which is great. All right, so what you need to understand is that you can never know if you're going to win the market or not, but eventually the secret is to use permanent sizes. Well, you cannot always use permanent sizes, but you will usually use the permanent sizes, and if your losses are lower than your profits, you should be green on the long term. All right, I hope this answered someone's question here about the false break and the other thing. Right, let's move on. So, as I said, you're welcome. As I said a few times um, during this webinar, I believe that as a beginners, you should not even look at the intraday chart. I mean, you can track or follow the price in the intraday chart, because obviously when you're looking at a price on the real time, it's ridiculous to look at the daily chart. But when you're analyzing a chart and when you're looking for trade ideas, and I know it sounds boring, but it's the most efficient trading way, especially for beginners, you should use the long time frame charts. So why is that? Why do I think that this is the more important thing for you? The main trend, which is, I like to say the phrase, the trend is your friend. And the main trend, the real one, which the technical traders should follow, appears in the best way in the daily or the weekly chart. Spotting the trend, hear carefully, spotting the trend covers 50% of the way to successful trade. Alright? If you know what is the currency's trade, you're almost half of the way to success. But another important thing is that the slow movement in the daily chart makes it much easier for you to manage the trade calmly. It will prevent you from repeating the mistakes that I was talking about, such as overtrading, reversing from short to long positions, and being stressed. Now, the problem is that most of us are looking for excitement in trading. I know that. And daily charts obviously don't supply this service. So as I said, therefore, if you insist watching your monitor every 5 minutes, use the intraday charts 1 or 4 hours, but try to take your decisions according the daily chart. Don't base your decisions on the intraday chart. In time, when your trade management skills improve, you will be able to implement the same techniques in the intraday trading. However, today, for myself, I can tell you from my experience that I got the same advice. I mean, when I started my first steps on forex, someone told me, don't even look at the intraday chart, just trade the daily chart. And obviously I didn't hear from him. I didn't take this advice, and I just traded a 5-minute chart. So I lost a lot of money. Well, not that a lot of money, but for me it was not a small amount. And after a while I decided to put everything behind and started trading just the daily chart. And though it was much less exciting in the beginning, I started to make money, and this is the more important thing, because it's the same analysis. It doesn't matter if it's stocks or forex, 5 minutes, weekly, it's the same analysis. The story of the candlesticks is the same for each instrument and any time frame. But for you, it's much easier to handle on the mentality aspect when the trade is much calm. And this happens only when you trade the daily chart. Alright, questions. First of all, you may take any decision that you want. It's not for me to allow you. But yeah, weekly chart is great as well. My favorite is daily. I think weekly is great as well, but um, it's for the core traders, and it requires much more um, patience. You know, when you take a trade on the weekly chart, you need to wait several weeks um, in order to understand the full picture and to see whether the trade is successful or losing. Another thing is when trading long time frames, obviously the potential loss is higher, so you need to reduce the size that you use. I hope that this is clear for all of you. If let's say that I used to trade the intraday chart and my average stop loss was 100 pips, and now I'm trading the daily chart and it's 400 pips, I cannot continue trading with the same sizes, right? As I said on the first rule, you need to ask yourself, what is the maximum loss that I can take in dollars or euros? Calculate what is the trade potential loss, and then decide what is the size I should. When I move my stop loss order to break even, well, after I take my profit, and again, I will answer this one on my next webinar, which is about money management. But a quick answer: when I take the profit, my partial profit, the stop loss level doesn't has something to do with whether I took the profit or not. I look at the chart, and if I see a better stop loss level, then I move it up. All right. I can't say in advance how long I wait until I move my stop loss. I mean, I need for the chart to tell me whether I should move it. All right. If it's a long position, I always look for higher low. When it's a short position, I look for lower high, and then I move my stop loss along the trend. Well, I think that using $100, it just for practice. I mean, it will obviously force you to use high leverage. I mean, most of the brokers has a minimum of 0.1, which means that you have per trade. So, which means that you will have to trade at least leverage of 1 to 10, which is pretty high for this small account. So my advice to you is maybe that you will deposit more money but use lower leverages. Then your way to raise your balance, which will be much longer, because depositing $100 and using high leverage is like gambling at the end of the day. Let's face it. You deposit $100, you use high leverages, you don't have enough distance to play, and you're most likely to erase your account. Obviously, I've seen many traders though that deposited $100 and turn into $500 and then to $1,000, which is great amount of money to trade, especially in forex. And so you can try this. All right, Zeus. All right, so my last advice for you is to record your trades. And when I'm saying record, is just using a simple table, for example, an Excel table, to record the details of your trades. And what you need to write and submit to your tables is just the open or close price, whether it was a short or long position, obviously the size of the trade, and any kind of remarks that you want to add, such as, for example, if you think that a trade worked for a certain reason, mention it. If you think that it failed for a certain reason, you can mention this as well. Why is it important? First of all, it will help you to realize the causes of your losing trades. I mean, after a while, after a month or a couple of months, you will have a pretty large database that you can analyze and come to conclusion according to this data. And it will help you to it helps demonstrating, which factors make you profitable. All right, for example, let's say that you find out that you make money just during the time that Wall Street is opened. So you know that you trade from now on only when the US stock market works. Just for example. All right, so this can help you for both realizing what are the elements that cause you losses and which elements you need to support because they help you to gain money. All right, so to conclude, basically we talk about 7 rules. So we talk about small leverages, don't quit your job, don't overtrade, record your trades. What else? Let's see. Oh, learn from experienced traders. And that's it, I think. Oh, and setting the trades targets before you enter the market, and stop loss. All right, stop loss and profits. You will probably need to see this webinar again. You will be able to find it on our website, on Sunbird FX website, in a couple of days. Any questions? What do I mean by short squeeze? Did I say this phrase, this term? I don't think that I mentioned the short squeeze during this webinar. But a short squeeze is when the short position holders has to close their position in market prices, and eventually it happens when many short positions are opened and something causes the instrument to rise. All right, and all the short position holders are closing it in market prices, and that caused the instrument to jump. All right, this is a short squeeze. All right, thank you very much, everybody. I hope you enjoyed and you learned today from this webinar. Thank you for Forex Pros to host this webinar. We're closing the record now, but I'm still available if you want to ask some questions.